On October 17, Nifty almost touched a high of 19,850 during the day, merely on the news of US President Joe Biden's visit to West Asia, because the market was hopeful that Joe Biden's visit would improve the situation and the war situation won't worsen. But after the news of a rocket attack on a hospital in Gaza, the situation suddenly worsened, due to which the market sentiment became weak, and within 2 days, Nifty took a nosedive of about 200 points. Now, seeing this decline, many people might be feeling that buying opportunities are being created in the market. But the big question is, if buying opportunities are being created, then in which companies should one invest money? Now, when it comes to investing money, everyone wants to get good shares, and that too at a cheap price. That is, at a cheap valuation. So, what exactly is the definition of cheap and good shares? Let us first understand that. Cheap shares are those shares whose valuations are cheap, not those shares which are cheap on the basis of price. Now, generally, we estimate cheap and expensive from the PE, that is the price to earnings ratio. So, how low should the P by E be? For this, we consider Nifty as the yardstick. Now, as per the closing of 19th October, Nifty was trading at a P by E multiple of around 22 points. And out of 500 companies of Nifty 500 index, 111 were trading lower than Nifty's, that is below 22. But it is very difficult to choose from these 111 companies or to make a portfolio. But if we look at the companies with the P by E below 10, out of these 111 companies, then only 31 companies are left in the list. Now, out of these, there are 16 companies whose quarter-on-quarter profit growth has been negative in the first quarter. If we remove the companies with a negative PAT growth, only 15 companies are left. That is, those companies which have P by E of less than 10, had a positive profit growth in Q1, and which have given less than 50% returns so far this year. Among these, Vedanta, SBI and JK Paper are three such names which have given negative returns ranging from 2% to 26.5%. That means these three stocks have fallen this year. Now, which of these 15 companies can be included in the portfolio? Well, to answer that question, founder of Mantri Finmart, Arun Mantri, believes that most of the names of these 15 are public sector units or PSUs. Due to the fear of government interference and any change in policies, these companies get low P by E multiples. From the list, Canara Bank, IOC, LIC Housing, JK Paper, SBI, Uno Minda and Manappuram Finance are the favorite stocks which should be bought with a perspective of say 1 to 2 years. Now, these shares are expected to yield annual returns of 15 to 20%.